January 21st, 2026. Tuesday morning, Tokyo. A single trading session just destroyed what took 30 years to build. Japanese government bonds, the safest asset in Asia, collapsed so violently that traders are still trying to process what happened. The 40-year bond yield spiked above 4% for the first time in history. The 30-year yield jumped 30 basis points in one session. Pramod Dewan, a fund manager at PIMCO, said it best when he called it a quarter-point surge in yields happening before lunch, something that used to take months. And while most people were watching US markets or checking their crypto portfolios, a $7 trillion bomb was silently detonating in Tokyo. Bitcoin didn't crash yet, but the fuse is lit. And honestly, if you don't understand what just happened in Japan, you're about to get blindsided again. Let me show you something that genuinely terrifies me. In the last 72 hours, Japan's 10-year bond yield hit 2.38%, the highest since 1999. The 30-year yield is now at 3.67%, up 120 basis points since January 1st. That's not normal market movement. That's a structural break in a system that's been stable for decades. And here's what nobody's telling you. What keeps me up at night thinking about the global implications. Japan holds $1.2 trillion in U.S. Treasury bonds, more than any other country on Earth. When Japan's own bonds start paying real interest for the first time in 3 decades, Japanese investors don't need to hunt for yield in America anymore. They bring their money home. All of it. And when $1 trillion starts moving across borders, every market on Earth feels the tremor. Stocks shake, bonds crack, real estate freezes, and yes, Bitcoin bleeds. But let's rewind because this doesn't start last week. In 1991, Japan's economy imploded. The Nikkei crashed from 39,000 to 14,000. Property values fell 80% overnight. The Bank of Japan panicked and did what every desperate central bank does. They printed money and dropped rates to zero, then below zero. For 30 years, Japan ran the most extreme monetary experiment in history, keeping their entire financial system on life support. It worked. Kind of. The economy didn't collapse, but it never recovered either. It just existed, stagnant and dying slowly. That's the backdrop. 3 decades of free money that created the biggest carry trade in history. Fast forward to 2024. Inflation finally hit Japan hard. Real inflation at grocery stores and gas pumps. The Bank of Japan couldn't ignore it anymore. In December 2024, they raised rates to 0.75%. The highest in 30 years. Doesn't sound like much, but in a country with zero rates for 3 decades, it's an earthquake. And now, in January 2026, the aftershocks are tearing through everything. Because raising rates is one thing, but convincing the market you can afford it without destroying your economy is another. And this is where it gets absolutely wild. Enter PM Takaichi, Japan's new prime minister, a political gambler who just made the most reckless bet I've seen in years. On January 19th, she dropped a bomb that made every bond trader in Tokyo reach for the sell button. She called snap elections for February 8th, and to win votes, to buy herself political survival, she made a promise that's either genius or suicide. She's suspending the 8% consumption tax on food for 2 years. Sounds amazing, right? Cheaper groceries for everyone, free money for voters. Classic populist move. But here's the catch that makes this absolutely insane. That tax generates $32 billion a year in government revenue. And Takaichi has zero plan to replace it. No alternative revenue. No spending cuts, just a giant hole in the budget. But she didn't stop there. Oh no, she also announced a $115 billion spending package. More roads, more infrastructure, more handouts. So let me get this straight. She's cutting $32 billion in tax revenue while simultaneously spending an additional $115 billion. And Japan already has the highest debt-to-GDP ratio in the developed world at over 240%. The US is at 125% and people panic about that. Japan is at 240% and climbing. They're drowning in debt, and Takaichi just announced she's going to borrow even more while cutting the taxes that pay for the debt. It's financial madness dressed up as a campaign strategy. The bond market saw through it instantly. Within hours, chaos erupted. The 40-year bond yield exploded to 4.21%. The 20-year yield jumped 22 basis points in a single session. Veteran traders who've been doing this for decades said they'd never seen anything like it. The 10-year yield surged to 2.38%. And the message from investors was crystal clear. We don't trust you. We don't believe you can pay this debt back without destroying the currency. Sell orders flooded in, panic spread, and Takaichi's political gamble became a financial disaster in real time. But here's why you should care about Japanese bond yields, even if you've never heard of them before. This isn't just Japan's problem. This is about to become your problem, because for 30 years, the Japanese yen has been the cheapest currency in the world to borrow. Hedge funds and banks have been running what's called the yen carry trade, and it's massive. Here's how it works. You borrow yen at 0% interest, convert it to dollars, buy stocks, bonds, real estate, crypto. As long as the yen stays weak and rates stay low, it's free money. Estimates put this trade at over $3.4 trillion globally. Some think it's closer to $5 trillion. That's trillions of borrowed yen pumped into global risk assets, including Bitcoin. And now that trade is breaking. When Japan raises rates, the yen strengthens. When the yen strengthens, you lose money paying back your yen loans. So you panic sell everything. And that's happening right now. Look at what Bitcoin did. Between January 11th and January 21st, while Japanese yields were spiking, Bitcoin dropped from $92,000 to $87,500. A 5% decline. Not a crash yet, but a warning. This has happened before. 3 times in the last 2 years. Every time Japan tightened policy, Bitcoin got destroyed. March 2024. Bank of Japan raised rates. Bitcoin dropped 23%. July 2024. They hiked again. Bitcoin crashed 30% in 2 weeks, from 65,000 to 50,000. The carry trade unwound so violently that crypto lost $3 billion in one day. January 2025. Rates went to 0.5%. Bitcoin fell 31%. 3 times, 3 crashes. And now we're here again. The Bank of Japan held rates steady last Friday, but bond yields are surging on their own. The market is betting on more hikes, and if the pattern repeats, Bitcoin is about to get obliterated. Crypto analyst Merline the Trader said it perfectly. The Bank of Japan might be Bitcoin's biggest enemy. Every time they hike, Bitcoin bleeds. If the pattern holds, we could see $70,000 or lower. Think about that. Bitcoin is at 90,000 right now. A 20 to 30% drop takes it to 63,000 to 72,000. That's not a dip. That's a wipeout. And most retail investors have no idea this is coming. They're not watching Japanese bond yields. They're not tracking the yen. They're just watching their portfolio bleed and wondering why. Here's the truth nobody wants to hear. Bitcoin isn't crashing because of crypto news. It's crashing because of liquidity. And liquidity is controlled by central banks. For years, Bitcoin was sold as digital gold, independent from traditional finance. But the data says otherwise. In late 2025, Bitcoin's correlation with the Nasdaq hit 46%, with the S&P 500, 42%. When stocks fall, Bitcoin falls harder. When Japanese yields spike, Bitcoin crashes. It's not independent. It's tied to the global financial system, and right now, that system is tightening like a noose. So what happens next? Japan's election is February 8th, less than 2 weeks away. If Takaichi wins and implements her plan, the bond market could explode. Yields could spike higher, the yen could surge, and the carry trade could unwind catastrophically. Analysts predict $500 billion could flow out of global markets back to Japan over the next 18 months. $500 billion of liquidity sucked out of stocks, bonds, and crypto. And even if Takaichi loses, the damage is done. The bond market has repriced Japan's risk. Yields aren't going back to zero. The era of free Japanese money is over. For Bitcoin holders, the next few weeks are critical. If Japanese yields stay above 2.3%, Bitcoin could test $87,000 support. If that breaks, next stop is $82,000. If the Bank of Japan signals another hike, we could see liquidations push Bitcoin below $75,000. I'm not trying to scare you, I'm trying to prepare you. But there's a counter-argument. Some analysts say if the Fed keeps cutting while Japan tightens, Bitcoin could bottom soon and rally hard in Q1 2026. Dollar liquidity could offset yen tightening. It's possible. I don't know which scenario plays out, nobody does. But I know this. Smart money is already moving. Large Bitcoin wallets have been moving coins to cold storage since early January. Not selling on exchanges, protecting positions. They know something. And here's the brutal truth. You're hearing this days after insiders moved. The bond crash was January 21st. It's now January 27th, 6 days late. If this is the first time you're connecting Japanese bonds to Bitcoin, you're behind. But it's not too late to protect yourself. Reduce leverage now, tighten stop losses, take some profit if you're overexposed, and watch Japan. Not the Fed, not Twitter. Watch Japanese bond yields, watch the yen. That's where the next move comes from. This isn't just about Bitcoin. This is about the end of the free money era. For 15 years since 2008, central banks flooded the world with cheap liquidity, zero rates, money printing. That inflated every asset. Stocks to all-time highs, real estate parabolic. Bitcoin from $1,000 to $69,000. But now it's ending. Japan was the last holdout. Even they're tightening. What comes next is a world where money costs something again, where leverage is expensive, where assets don't just go up automatically. And in that world, Bitcoin faces its biggest test. Can it survive without cheap liquidity? Can it prove it's actually digital gold? Or will it fall like every other speculative asset when the music stops? We're about to find out. January 21st, 2026 wasn't just a bad day for bonds. It was the day the market sent a message. The free money is over, the carry trade is dying, and if you're not prepared, the next crash won't just hurt, it'll wipe you out. The timeline is set, the math is clear, the pattern has repeated 3 times. Now the only question is, are you listening? Are you protecting yourself? Or will you be another liquidation statistic? The choice is yours. But the clock is ticking. And Tokyo doesn't wait for anyone. Don't let this catch you sleeping. Act now before it's too late.